What if I told you that the greatest trade in financial history wasn't based on numbers, charts, or insider tips, but on a shared lie? Not a lie whispered in secret, but one shouted in headlines, believed by economists, backed by governments, and bought into by millions. A belief so powerful it shaped a nation's policy. And one man, a philosopher turned investor, saw through it all. While others trusted the system, he questioned it. While the market celebrated, he waited. And when belief finally cracked, he struck. That man was George Soros. And on one single night in 1992, he made over $1 billion, not by predicting prices, but by diagnosing delusion. This isn't just a story about money. It's a story about perception, psychology, and the power of seeing what others deny. This is the mind of George Soros. Welcome to the man who traded belief. They say the market is ruled by numbers, that it responds to earnings, inflation, GDP, interest rates. They say it's rational, logical, predictable. But what if the market isn't a machine of reason? What if it's a mirror of belief, a theater of perception? George Soros didn't start as a trader. He started as a thinker, a refugee, a philosopher, a student of truth. While others were learning how to value a stock, Soros was questioning whether truth could ever be known at all. At the London School of Economics, he devoured the writings of Karl Popper, the man who said, "We do not know, we can only guess." That one sentence became the foundation of Soros's entire worldview. To him, markets weren't driven by facts, they were driven by guesses, by flawed assumptions, by beliefs, fragile, emotional, and dangerously contagious. And once he saw this, everything changed. He realized the market doesn't just reflect reality, it creates it. Every time a trader places a bet, it isn't just data in motion, it's belief in motion. And when enough people believe the same thing, even if it's wrong, it becomes real, at least for a while. That's the terrifying beauty of it. Bubbles don't start with lies, they start with faith. Faith that something will go up, that this time is different, that risk doesn't matter. And when that faith spreads, reinforced by media, influencers, politicians, it becomes a story so big, so loud, that no one dares question it. But Soros always questioned it. He trained himself to find the cracks beneath confidence, to hear the tremble in the voice of certainty, to see the illusion before it breaks. He built the quantum fund not just as a financial vehicle, but as a laboratory. Every trade was an experiment, a hypothesis, a test of belief versus reality. And when belief became delusion, when the market started believing its own lie, he struck, not with emotion, not with fear, but with cold, brutal precision. Because for Soros, belief was never harmless. It was a weapon, one that could be used to manipulate prices, shape policy, control narratives, and in the right hands, collapse empires. Just look at 1992. The British government was committed to defending the pound. The public believed them. The press cheered them. Even investors with billions at stake closed their eyes and hoped. But Soros, he saw the disconnect. He saw a government fighting gravity. He saw a loop of belief reinforcing itself, politicians lying to markets, markets lying to people, people lying to themselves. So he bet big, he shorted the pound, and when the illusion cracked, it broke fast. He made over $1 billion in a single day. Not because he had better models, not because he had better data, but because he understood this one truth. Markets are moved not by reality, but by the stories people tell about it. And belief, in the hands of someone who knows how to read it, becomes a map, a weapon, an edge. That's what most traders miss. They chase patterns, they analyze trends, they seek confirmation. But Soros sought contradiction. He looked for the places where belief was strong, but truth was weak. Because in that gap, that fragile space between illusion and reality, lies the most explosive opportunity. And he didn't fear being wrong. He feared being blind. So he questioned everything, even himself. He once said, "I'm only rich because I know when I'm wrong." Let that sink in. While others fall in love with their positions, Soros falls in love with the possibility that he might be wrong and prepares for it. He uses risk as a scalpel. He sizes up when conviction is clear and cuts fast when doubt creeps in. He doesn't pray for certainty. He profits from uncertainty because he knows, in the market, the most dangerous thing isn't volatility, it's believing too much. So next time you look at a trade, ask yourself, am I betting on the price or on the story behind it? And what happens when that story stops being true? Because if you don't know what the market believes, someone like Soros does, and he's already positioned for when you find out, too late. Let's be honest for a second. Most of us, when we lose money in the market, we blame the chart, the timing, the news, the market makers. But what if the real enemy was our own belief? George Soros understood something most traders still don't. You are not separate from the market. You are part of the machine. Every decision you make to buy, to sell, to hold isn't just a reaction. It's an input. Your belief moves price. Price confirms belief. And that cycle, if left unchecked, becomes a psychological loop. This is the heart of Soros's theory of reflexivity. It's not just a trading concept. It's a way of understanding how mass delusion becomes market reality. Think of it like this. A group of investors believe an asset is undervalued. They buy. Price rises. That price rise makes others believe the asset must be good. So more people buy. The rise confirms the belief. More buying, more confidence, more headlines. The loop feeds itself. And nobody stops to ask, was any of this real? That's how bubbles form. That's how they inflate, and eventually how they explode. And here's the terrifying part. Even smart people fall for it. Why? Because once the loop forms, it starts to feel like truth. We don't just invest in assets, we invest in narratives. We want to believe, and that desire to believe is what reflexivity preys on. Because in this loop, your assumptions create the very evidence you use to justify them. It's like walking through a funhouse mirror, nodding confidently at your own reflection, unaware that it's warped. Soros didn't just see this loop, he trained himself to detect it. He didn't ask, what is the market doing? He asked, what does the market believe it's doing, and how wrong could that be? That question changes everything, because when you think like this, you stop chasing the price. You start stalking the story. You look for euphoria without foundation. You look for fear that feels exaggerated. You study headlines not for information, but for desperation, because when the crowd screams certainty, Soros hears fragility. Let me give you a concrete example. Think back to the 2008 housing crisis. The narrative was simple. Home prices always go up. People believed it, so they borrowed. Banks packaged the debt. Ratings agencies nodded. Investors piled in. Prices soared, and everyone pointed to the chart and said, see, we're right. But Soros would have asked, what belief is holding all this together? And more importantly, what happens when that belief breaks? Because once a loop breaks, it doesn't unwind slowly. It unravels fast. Fear replaces confidence. Panic replaces patience. Everyone rushes for the exit, and the door suddenly feels too small. You've seen this before in meme stocks, in crypto, in every asset that goes parabolic for no clear reason. It's not driven by logic. It's driven by belief. And when belief reaches saturation, when everyone believes, you must ask, who's left to buy? That's not pessimism. That's pattern recognition. Reflexivity doesn't just explain irrational markets. It explains you. If you've ever held a position because Twitter was bullish, if you've ever bought because a friend made money on something going to the moon, if you've ever stayed in a trade because everyone else is still in, you weren't trading logic. You were trading loop psychology. And that's okay if you're aware of it, but most traders aren't. They think they're watching the market, when in fact, the market is watching them. Soros knew this. He didn't just observe belief, he bet against it when it became blind. Because here's the thing, belief is powerful, but belief without questioning is fatal. So how do you apply this? You start by looking for the story. What does the crowd believe right now? What's being priced in as a certainty? And then you look deeper. What fundamentals are being ignored? What contradictions are being dismissed? What doubts are being silenced? When you find that gap between story and substance, you've found the loop. And where there's a loop, there's a lie. And where there's a lie, there's profit. But only if you're willing to see it first. The crowd doesn't spot the loop. They are the loop. Your edge is stepping outside it, even when it feels uncomfortable, even when it feels insane. Because remember this, the louder the belief, the closer it is to breaking. Most traders are staring at the wrong thing. They're glued to candles, waiting for patterns, counting indicators like they're sacred signs from the market gods. Double bottom, buy, RSI overbought, sell, breakout, jump in. It feels logical, it feels professional, it feels safe. But here's the truth. Soros didn't care about your chart. He cared about your mind because he understood something almost no one else did. Price is not the beginning. it's the end. Price is not the signal, it's the symptom. It's the byproduct of belief, of mass psychology, of stories we all silently agree to pretend are true. Let me say that again. Price is what happens after the story already took hold. And by the time you see it on the chart, someone else has already acted on the belief behind it. Soros never needed a golden cross to enter. He needed tension in the plot. He looked for moments when the story no longer made sense, moments when the narrative cracked, even just slightly, because that's where opportunity lives. Let's talk Black Wednesday, the most famous trade of his life. The UK was part of the European exchange rate mechanism, a system designed to keep European currencies stable within a fixed band. The public story? The pound is strong. The government will defend it. Europe is united, but Soros saw behind the curtain. The fundamentals didn't support the exchange rate. Inflation was rising, the UK economy was weak, interest rates were misaligned, and yet politicians insisted it would hold. The press cheered them on. Investors, too scared to question, nodded in unison. It wasn't just a bad policy, it was a fragile belief propped up by pride and fear. And Soros did what most never dare to do. He bet against the story. He shorted the British pound with $10 billion, not because of a chart pattern, not because of a MACD crossover, but because the narrative no longer matched reality. He didn't trade the price. He traded the moment when belief would crack. And when it did, the pound collapsed. The UK exited the ERM, and Soros made over $1 billion. That's the difference. He wasn't playing technicals, he was playing psychology. He wasn't trading data, he was trading delusion. Let's bring this back to you. Think about your last trade. Why did you enter? Because the chart looked strong? Because volume was up? Because it broke resistance? That's fine. But did you ever ask, what story is the market telling right now? And what happens if that story breaks? If not, you're not trading the market, you're trading a shadow of it. Because every chart is just that, a shadow, a reflection of thousands, sometimes millions of people reacting to a story they believe to be true. But when the story shifts, the shadow disappears. And you're left wondering, what happened? Soros trained himself to anticipate that shift. He read central bank speeches, watched sentiment surveys, studied news cycles, not to follow, but to find cracks. If the market believed inflation was transitory, he asked, what if it's not? If the market said the bull run is just beginning, he looked for signs that optimism had peaked. He didn't care if everyone agreed. He cared if everyone was too confident. Because that's when the story is the most fragile, right before it breaks. It's like a house of cards. Looks stable, feels stable, then one gust of reality, and it all falls. And here's where it gets uncomfortable. The better a story sounds, the more it's repeated, the more comfortable it makes people feel, the more dangerous it becomes. Because strong stories don't live in markets, they live in minds. And minds are emotional. So, how do you shift your mindset? Start by looking at your positions. Ask yourself, what is the dominant belief driving this price? Is it based on earnings, on sentiment, on hope? Now ask, what happens if that belief no longer holds? What evidence would break it? Not the price, the narrative. If you can't answer that, you're vulnerable. Because Soros would be on the other side, watching, waiting, not for your indicator to flash red, but for your confidence to quietly collapse. That's how he traded. He stalked the lie, he studied the believers, and when the story broke, he didn't hesitate. He pressed, not because it was comfortable, but because he was prepared. It's easy to be bold when the crowd agrees with you. It's easy to sound smart when everyone is saying the same thing. But that's not courage. That's comfort. True courage, it's quiet. It's uncomfortable. It's lonely. And sometimes it looks like madness. George Soros didn't become a legend by blending in. He became a legend by thinking differently, and more importantly, by acting on it when it mattered most. Go back to the eve of Black Wednesday 1992. The British government had pledged to defend the pound. The Bank of England was all in. The press echoed confidence. Investors clung to hope. The world believed in the story. But Soros, he saw the contradiction. He saw a narrative held together not by truth, but by fear. And he did the unthinkable. He bet against a nation, against a currency, against the will of a government, against the dream of European unity. While others trusted the speeches, he trusted the numbers. While the market was singing, he was sharpening his blade. That's not just strategy, that's psychological warfare. And to pull that trigger, you need something that no indicator can give you: emotional detachment. You need to silence the noise, silence the doubt, silence the doubts, the pressure, and trust something deeper: your logic, your preparation, and your willingness to be hated before you're proven right. Here's the truth nobody wants to say: you felt this before. That moment where everything inside you whispered, "This is wrong." But every voice around you said, "You're just being paranoid." That's not fear. That's your survival instinct. And most people ignore it because we want to belong. We want to be right together, even if we're wrong. We crave validation more than we crave truth. Soros didn't. He didn't need the crowd to clap. He didn't need Twitter to agree. He didn't need confirmation from the herd. He trained for that moment when everyone else said hold and he said short. When everyone saw strength and he saw the lie. Because in markets, the real danger isn't being wrong, it's being late. By the time the story collapses publicly, the profit is already gone. Soros acted before the crowd understood, because he knew belief is loudest right before it dies. You know this moment too, that stock that everyone loved but you felt was hollow, that rally that seemed built on hope, not substance. You felt it, but you hesitated. You scrolled Reddit, you checked influencers, you waited, and the moment passed. That gap between knowing and doing, that's where courage lives. That's where profit lives. But here's the uncomfortable twist: being contrarian hurts. It's not glamorous, it's not romantic, it's isolating, it's filled with doubt. It feels wrong until it works. Soros journaled his thoughts, wrote down his fears, not because he was weak, but because he was human, and he wanted to be stronger than his own emotion. He studied history, not just for price patterns, but for human behavior. He didn't fight fear, he used it. To him, fear wasn't the enemy, it was a compass. If a trade didn't scare him, it probably wasn't bold enough to matter. He didn't bet big for ego. He bet big when the story was fragile, the risk was asymmetric, and the belief was overdue to break. And when that moment came, he didn't flinch. He pressed. Because here's what most people never train for: what to do when you're actually right. They prepare for failure, they don't prepare for opportunity. Soros did both. He didn't just survive the chaos, he waited for it, he studied it, he welcomed it, because chaos is where the loop breaks, and where the loop breaks, the contrarian wins. So ask yourself, when have you felt the crowd was wrong but stayed quiet? When did you see the flaw but hesitated to act? When did fear stop you instead of guide you? That's your work. That's your edge. Because anyone can think differently in hindsight. But to act on it while the world still believes, "Verdes pays," that's courage. And that's why Soros won. Not because he was always right, but because when the moment came, he was the only one with the guts to move. You can't control the market. You can't control the crowd. You can't even control the news. But there is one thing, one battlefield, where you must gain control: yourself. Because when chaos erupts, when the chart goes vertical, when Twitter screams to the moon, that's when most traders lose. Not because they misread the chart, but because they misread their emotions. George Soros knew this better than anyone. He didn't trust emotion. He didn't try to suppress it either. He studied it, measured it, used it. Emotion wasn't his enemy. It was his early warning system. See, most traders think their edge is in analysis, but Soros knew the edge is in response. How you respond when the market tests you, how you respond when the crowd tempts you, how you respond when your own fear and greed try to hijack the wheel. That's why Soros kept a trading journal, not to track profits, but to track his own mind. Before each trade, he would write, "What do I believe? What am I feeling? What assumptions am I making?" He treated his own brain like an instrument in need of calibration. And here's where it gets strange, but brilliant. There were times Soros would feel a strange tension, a tightness, a dull pain in his back. He learned that this wasn't random, it was his body reacting to internal conflict, and he listened. He once exited a massive position, not because of new data, but because his body told him something was off. Days later, the market crashed. Call it instinct, call it pattern recognition, call it what you want. But the point is, he didn't let pride or certainty override his awareness. You see, most traders double down when they're emotional. They add size to losing trades. They hold because they believe. They ignore warning signs because the position felt good yesterday. Soros, he detached. He reassessed. He walked away without flinching. That's not weakness. That's surgical discipline. Because here's the truth. In trading, clarity is rare. And when it appears, you must be ready to act without hesitation. But clarity doesn't feel comfortable. It doesn't come with fireworks or applause. It feels quiet, still, focused. And most traders miss it because they're still wrestling with emotion. Think back to a trade you cut too early. Not because the idea failed, but because you got nervous. Or a trade you held too long because you were hoping, praying, refusing to admit it was over. Now imagine this. What if you had documented your thoughts before the trade? What if you had written your thesis, your risk tolerance, your emotional state? What if, in that moment of pressure, you could step outside yourself and see clearly, this isn't logic speaking, it's fear. That's what Soros trained for. He didn't just analyze markets, he analyzed himself. And when the story changed externally or internally, he evolved. No ego, no apology, just action. That's why he could go long one day and short the next. That's why he could lose millions and smile, because he learned something. That's why he didn't just make winning trades. He made trades that matched his mental state. He understood that reflexivity applies to himself too. Every belief affects his action. Every action affects his outcome. And every outcome loops back into his belief. He wasn't just watching feedback loops in the market. He was tracking the one inside his own mind. So how do you trade like that? Observe yourself as much as you observe the chart. Write down your assumptions before they blind you. Check your body, not for drama, but for subtle tension. Step back before stepping in. And most importantly, learn to separate your identity from your position. A losing trade doesn't make you wrong. A winning trade doesn't make you right. What matters is, did you follow your process? Did you stay aware? Did you remain objective when others were losing control? That's the work. That's the edge. That's precision over emotion. Because at the end of the day, the market doesn't punish your logic, it punishes your attachment. And Soros, he never got attached. He just got prepared. If George Soros were 30 years old today, he wouldn't be analyzing the British pound. He'd be on Reddit, he'd be scrolling Twitter, he'd be watching TikToks about meme stocks, altcoins, and AI plays, not because they're rational, but because they are reflexive on steroids. Welcome to the modern market where belief spreads faster than truth and prices respond before fundamentals even move. Let's talk crypto. At the heart of every boom isn't a breakthrough, it's a story. Bitcoin is digital gold. Ethereum is the future of the internet. This meme coin will make you rich. None of that is data. None of that is certain, but it doesn't have to be. Because when millions believe something together, even for a short time, that belief becomes price. And as price rises, the belief feels more true. So more people believe, they buy, the price goes higher, and the loop spins faster. That's modern reflexivity. It's not slow, it's not subtle, it's viral. Now add social media to the mix. TikTok amplifies excitement. YouTube monetizes conviction. X, Twitter rewards bold opinions. Discord communities form echo chambers. Algorithms feed you what you already believe. You're not just watching the loop anymore, you're inside it. And here's the dangerous part. When your beliefs are constantly echoed back at you, they start to feel like facts. But Soros would ask, where is the story too clean? Where is the narrative too perfect? Where is no one asking the hard questions? Because that's where reflexivity builds the fastest and collapses the hardest. Let's take the 2021 Bitcoin rally. The story? Institutions are buying. Adoption is inevitable. Price hit $60,000, $65,000, $69,000. Media called it the new financial order. Retail flooded in. Companies changed their names to include blockchain and saw their stocks double overnight. Everyone believed. But underneath, hash rates were plateauing. On-chain data showed weakness. Regulation was tightening. The story was getting louder, not smarter. That's your red flag. Because in reflexive markets, euphoria is the signal, not the reward. It means the belief is overextended. It means the loop is running on fumes. It means someone like Soros is getting ready to strike. And it's not just crypto. Remember 2023, the AI stock mania? Companies added AI to their press releases and added billions in market cap overnight. Did their products change? No. Did their earnings justify the move? Not even close. But the belief, the hype, the momentum created its own reality for a while. That's modern reflexivity. And if you're not aware of it, you're trading someone else's story. So, what would Soros do today? He'd track belief velocity. How fast is a narrative spreading? Is it hitting saturation? Who's left to buy? Who's afraid to question? And when the narrative tightens, when the belief becomes religion, that's when he moves. He's not trying to outcode the quants, he's outthinking the crowd. And you can too. Here's how: watch sentiment like a hawk, use search trends, Twitter mentions, YouTube views. Don't trade the hype, diagnose it. Study divergence. Are fundamentals lagging belief? Is price rising while value stalls? Detect the shift. When does confidence become cockiness? When does skepticism vanish completely? Prepare your strike. You don't need to short every rally. You just need to know when the story is too good to be true. Because here's the cold truth: when the crowd is loudest, the exit is smallest. And that's where reflexivity becomes a trap. You're not chasing alpha, you're chasing approval. You're reacting to a price that was never based on value, just shared emotion. So pause for a second. Look at your portfolio. Are you holding a coin because you understand it or because your friends are in it too? Are you buying a stock because the fundamentals check out or because it's all over your feed? If you can't answer that clearly, you're already in a loop and you don't even know who wrote it. But Soros would, because he doesn't wait for the crash. He watches for the buildup, not the breakout, not the parabolic move, but the blind belief beneath it. That's the inflection point. That's the weakness. That's the edge. And if you can read that moment, you don't need billions to be dangerous. You just need clarity in a world addicted to noise. By now, you've seen how Soros thought, how he studied belief, how he stalked feedback loops, how he bet big when stories began to crack. But here's the question that matters now: how do you think like Soros? Because this isn't about copying trades, it's about copying a lens, a way of seeing the market and yourself differently. So let's break it down. Here's how to build your reflexive model, the Soros way. Step 1: define the narrative. Before you ever look at a chart, before you touch an entry, you ask, what does the market believe right now? Not, is this bullish? Not, what does the trend say? But, what's the story? Is it AI is going to revolutionize everything? Interest rates are done rising. Crypto is the future of finance. Whatever it is, name it. Put it into a sentence. Because if you don't know what belief is driving the price, you'll never see when that belief starts to break. Step 2: detect the feedback loop. Now ask yourself, is this story becoming self-reinforcing? In other words, are rising prices fueling more belief? Is that belief pulling in more buyers? Is that buying pushing the price even higher? That's your loop. And the stronger that loop becomes, the more fragile it gets. Why? Because it no longer needs value. It runs on momentum and faith. And when faith breaks, the loop collapses fast. Step 3: gauge belief saturation. You need tools here. Look at Twitter sentiment. Search Google Trends. Scan Reddit and YouTube. Analyze funding rates and options volume. Study analyst headlines. Now ask, has this belief reached a point where no one's left to join? Because if there's no one left to buy, even the best story turns into a trap. That's what Soros mastered. He didn't just time the market, he timed belief saturation. Step 4: design the asymmetric bet. This is the part most traders get wrong. They get the idea, they even spot the loop, but they don't structure the trade. Soros did. He asked, what's the maximum I can lose? What's the potential upside if the story breaks? How much conviction do I have? He used small size when uncertain. He scaled in as probability increased, and when clarity arrived, he went for the jugular, not recklessly, but with calculated precision. Because when a reflexive loop breaks, moves are fast. You don't have time to react. You only have time to execute. Step 5: track your own loop. Here's what separates Soros from the rest. He didn't just monitor market reflexivity, he monitored his own mind. Every trade he took, every thesis he built, he wrote it down. Why? Because he knew my mind is also part of the system. Every assumption he made, every emotion he felt, every hesitation, every surge of confidence could affect his judgment. So he built self-awareness into his model. Am I chasing? Am I biased? Did I change my opinion because of data or discomfort? That kind of honesty, it's rare and it's powerful. Step 6: stay evolving. This is the hardest part, because once we find a method that works, we cling to it. We repeat it, we worship it, but the market changes. Narratives shift, the crowd learns. What worked last year may fail tomorrow. Soros didn't cling. He questioned everything, even himself. That's why his edge never dulled, because he never stopped sharpening it. So let's bring this home. If you want to think like Soros, you don't need billions. You don't need insider access. You don't need hedge fund tools. You need awareness of stories, of loops, of saturation, of your own bias. That's what gives you an edge in any market, any cycle, any decade. Because while others are still reacting to charts, you'll be reading belief, tracking sentiment, timing fragility, and striking when it matters most. This is how predators think in markets full of prey. This is how Soros won, and this is how you build a system that outlives hype, outsmarts emotion, and outlasts the crowd. We've talked about George Soros, the man, the method, the mindset, but this was never really about him. It's about you. Because in the end, the market is just a mirror. It reflects not truth, but perception, not logic, but emotion, not fundamentals, but the stories we tell ourselves to feel safe. And sometimes those stories turn into traps. Soros didn't win because he was smarter. He won because he knew when the crowd starts to believe the story too perfectly, that's when it's most likely to break. He didn't worship charts, he watched psychology. He didn't chase momentum, he stalked belief and timed when it cracked. And he trained every single day to hear that crack before anyone else. But here's the twist. This isn't just about markets, it's about you too. Your thoughts are reflexive. Your habits are loops. Your identity can be a trap, just like the price chart you worship. So before you trade again, before you open that position, before you convince yourself this time is different, ask, what am I believing right now? That might be false. Not the chart, not the trend, you. Because if you can find the lie before it finds you, you'll be the one holding clarity, not the bag. And if that clarity gives you just 1 second's edge before the crowd sees the smoke, then maybe, just maybe, you'll be the one holding the fire.